Welcome to this session of ValueCreator. We're going to go over the product management part of the suite. As you can see, there are a whole host of modules: business management, financial management, process management, project management, and service and support management. And today we're just going to talk about product management. Product management is focused around the concept of a product. And Salesforce already has a concept of product, but in product management, product marketing, we worry about a product before it's available to sell. You can actually create a product and not put it on any price list and then be able to refer to it as the product that you envision and that you're working forward on. If we go into our product area here, there's a number of different products. Some are already for sale and some are things to come. For example, these charter templates, the financial templates, those are things to come where the value creator. As you can see, there's various characteristics of a product. We can talk about what product family it's in. We can talk about what its product code or what its model number, or some people might refer to this as the part number is. We can talk about what type of revenue it generates, whether it's a one-time upfront revenue or recurring revenue. Depending upon what other or whatever modules that you use, you may find it convenient to store certain market information about rate is this particular market for this product growing at, and what's your relative market share in this market. So there are various characteristics. There's also a concept of a process. Product is put together by a process, and we allow that process to be named here as to how the product comes together. It can also be used in a lot of the service industry. You sell a product, and then the process of how the deliverable comes to be for what you sold comes after the fact, where when you're doing like manufacturing, you build the product first and then you sell it. With services, you sell it, then you do the delivery. This process can refer to the delivery process. What are all the things that need to be done in order for this particular product considered to be delivered? We can talk about what is the cost of the product, especially if we're talking about a manufactured product. How much did it take to build this thing? What's the cost of it? There's also this concept of total cost, which means that how many of these have we sold times the cost of building each one would be the total cost, for example. One of the things that we want to be able to do with a product is to be able to look at its return on investment, which means that we have to have information about how much it sold, both in dollar value as well as in counts, as well as all the money that was spent. So return on an investment piece. We're investing by building product in advance, and so there's a cost to that. There are also, outside of the product costs, there are also other expenses that are not what we call cost of goods sold. Cost of goods sold is cost of the product. But there are other expenses outside of that. You end up having to do trade shows and other things in order to promote this product, make brochures or send out announcements or do webinars. All of those things incur costs. So the marketing costs, potentially even the development costs. What were the expenses related to this that are not part of the product cost, meaning the actual cost of building the product? We also, as I said, we want to keep track of what's the total revenue been generated from here. We also want to be able to keep track of what was the forecasted revenue versus the actual revenue that was produced. Same thing with what was the total number of units actually sold versus the forecasted number of units sold. There's another concept in finance which is called allocation. Some expenses are not directly related. When we talked about going out and doing brochures for the product, well, they're brochures about that product. They're clearly the cost is related to that product. But there may be other costs. Let's say when you're selling the product, you have a sales order team, you have a finance team, and they're working behind the scenes, bringing in products, and the products may go more than one on an order, and it gets very complicated. So what you decide to do is you're going to allocate that cost across all the products that are sold, for example, would be one way to do it. So there may be allocated costs. And again, you may forecast those allocated costs, and then you may have the actual allocated costs. Eventually, what you want is the actual return on your investment, or ROI, and what was the original forecast. A lot of people do the forecasted return on investment at the beginning of deciding to do a product, and you hear them talk a lot about that we should really do a retroactive return on investment, and that's really an actual return on investment. What this system does is to do that dynamically as costs and as revenue is actually incurred and actual revenue is received, the actual return on investment will actually continue to calculate throughout the product's life cycle, from the very beginning to the very end. I'm going to briefly touch on this. You notice down here that there's a quantity schedule and revenue scheduling. These can actually be used for doing what's called a revenue schedule, and also for helping with revenue recognition, especially when you're dealing with subscription products. The way that you actually account for that is to divide the revenue and distribute it over the period of time. So if it's a 12-month subscription, you take 1/12 of the revenue and recognize it every month. This particular area of the revenue scheduling allows you to define essentially the number of periods and then the allocated over a particular period of time. But we're not going to go spend a whole lot of time on other than to acknowledge the fact that it does allow for doing revenue scheduling, and you can do revenue recognition directly from within Salesforce. Actually, very few ERP systems actually support proper revenue recognition, and a lot of people do it outside and quite commonly in the spreadsheet. So it is possible to do that right here within Salesforce within this product. We can show you how to do that. Normally a product has a standard price, sometimes referred to as manufacturing list price, and then it may be on various price books. It may be on a government price book. It may be on an education price list. It may be on a North American price list. It may be on a Europe price list. It may be on an Asia price list. You can have multiple price lists, but you have one standard manufacturing suggested retail price for it. So this is a general concept that a product has around it. But long before a product exists, one of the things that happens is the due diligence process. And this due diligence process starts with looking at what markets do you want to go after? Where can you make revenue in? When you're thinking about creating a product or service, it's always in the context of a market, or it should be always in the context of a market. In this particular case, I've segmented the information in a couple of different ways. So an example here would be, you might think of a US market versus a Europe market. You might also think of markets by particular areas that you would sell into a company, whether it's part of a marketing organization, whether it's part of a product organization, whether it's part of project management, whether it's part of finance, the service piece of the company, selling it in the strategic planning area. So there are different ways that you might segment the market from the standpoint of who's consuming it and how do you get to those markets. So let's dive into one of these markets to get an idea of the characteristics that you might want to collect. Now again, one of the powers of this platform is that if you don't use these particular attributes right now in examining your markets, you can actually just take them off the layout temporarily, and as you need them, you can put them back on. The package comes with every conceivable field on it that somebody might want. I always recommend to start with where you are. So figure out which fields you're going to use out of here and take everything else off, and then add back stuff as you need them for the next stage of your maturity of this process. Many companies start with a very, very simple model for their market. Number one, they got to name them. In this case, we're talking about a PMO, which is Program Management Office of PMI, as a possible channel for marketing and to sell product into. And we're talking about strictly the U.S. market. Part of the reason for breaking the markets up geographically is that there are constraints and potentially even different channels of communications and various regulations and barriers that are put up by governments. So each country, and sometimes even each state, can put up stuff that acts as barriers to keep other people from coming in and competing with their people locally. That's quite often why you see things broken up geographically, as well as there are sometimes language barriers where people in a particular country primarily speak their own language, and therefore in order to enter that market, you have to consider that as one of the factors that people that are dealing with as well as the product need to be able to communicate in the language that people can best figuring out how to visualize their company as well as the product and how it would be used. There are a gazillion different little characteristics here. We talk about barriers to entry. We talk about what industry is in, whether it's cyclic. It may be something that's strong in the rest of the years except for summer, or it may be seasonal, be strong during the fall and winter, not so well in spring and summer. Those sort of seasonalities need to be understood. They call it power structure. What's the structure within the market? Who's the lead in here? How big is the dominant competitor in this space? How much do they speak? Is there one customer that essentially everybody listens to, and therefore you need to be able to work with that customer, otherwise no one's going to listen to you. There's also title, and we can briefly write them out here, and then there's a breakdown of title, and I'll show that here in a moment. There's also usually a selection process. That selection process also happens over a period of time. So it's good to understand what the selection process is within this market. How do they decide what products and services to buy, and how do they get through their approval cycles inside of their company? How many layers of approval are you going to have in order to get this thing approved? Or how many different areas inside of the company are going to have to be involved? Also, part of this is, where do they buy their products? Do they buy it at the store? Do they buy it online? Do they only buy it from salespeople who call them on the phone? What's the typical buying pattern? Where do they find and buy products from? And how long would it take for this new product to be developed? Are we talking about a week? We're talking about a month? We're talking about a quarter? We're talking about a year? All of those factors factor into the decision process, what we call the portfolio decision process, about which products and services should be offered in what market to maximize the profitability of the company, because the company lives on its cash. So we can talk about what the quality expectations are within the market, what is the image that your company is perceived in within this market. How's your pricing strategy relative to others? Are you a low-cost leader? Are you high-end premium? How are you going to structure your pricing relative to the other people that are within this market? Segments can be broken down. So you might have a U.S. segment that breaks down, for example, into west of the Mississippi or east of the Mississippi. That would be an example of taking a segment and breaking it down. You can have markets that are adjacent markets, which are what these forward and backwards segments are for. This concept that if you're going to have a higher level segment, you might have an example where this particular market is known to be a percentage of the higher level market. So an example of this is that 70% of Salesforce.com's products that they sell is in the professional edition space, and 15% of it's in the enterprise edition and unlimited edition space. If we're going to look at selling into the Salesforce market within professional edition, the other thing that we may want to know, getting back to this concept of real-time return on investment or ROI, is what's the particular profitability of a segment? I mean, we talked about a product, but within a segment, we're selling into a segment. How profitable is it? Because there may be specific costs to this segment, depending upon how we have to market, the channels of communication and how much they cost, and what sort of materials we have to put out to this market, what sort of fees do we have to pay to be major partners in it. All those things can sometimes be specific to an actual segment. Those costs can also be incurred because of the government. So there may be particular tariffs that are put on products that come in. Those have to be considered. And they only exist for this segment. That's why they're not considered part of product cost. They're part of this segment cost, because these costs are because this segment exists, and it could be different than the segment that's next door to it. We have the same thing. We have revenue, expenses, allocations, and cost again, and then real-time return on investment. Quite often we want to know how many possible customers are in this space, how many number of entities, number of organizations exist within this space. We may want also to know the number of employees that are within this segmented space, especially if we're going to be selling on a per license basis or per user basis. Then you want to understand the number of employees. It might be helpful to understand how much they spend per capita, which is taking how much money they spend every year and divided by the number of employees, gives you then the amount of money spent per employee. You also might want to look at what their typical selling price for this type of thing is as an average to that organization. For example, enterprise applications may, on a subscription basis, sell between, let's say, $10,000 and $30,000 per month. It's the expectation within that market of what the average sales price will be. We want to also be able to understand what the segment size in terms of total dollars that are available between all the competitors, and whether it has major competitors and who are they, and is that the major competitor monopoly. Be also interested in what percentage you have of the customer base and what percentage of the revenue base do you have, as well as the percentage of total profit that's being made within that segment. You might also be interested in what the margins are that are made within here, what's the cost of getting people to move over. Switching costs could be, for example, moving data from one system to another, massaging that data and reconstructing that data in different ways. And sometimes that can be an expensive item. So all of those things make up a segment and the characteristics around it. And part of knowing these characteristics is to try to look at this segment as compared to another segment. The characteristics of this might be wildly different than between the US and Europe, or it could be almost the same except for VAT tax, for example, in Europe. That it's potentially higher than the US sales tax, for example. And so we need to factor those into the pricing of how we price the product.